So welcome everyone. Thank you so much for being here. We're from CIBC Private Wealth Management, and we're involved in option trading extensively. We help our clients with managing their investments using covered call writing and selling cash covered put options to protect portfolios in down markets as well as generate additional income. We've been doing this for 23 years, and as you guys can probably imagine from the last names, our last name is Mehra, father-son team. Avin, he started his practice in 2000 with Merrill Lynch, and 1 year later, Merrill Lynch was bought out by CIBC Private Wealth, and that's how, formerly CIBC Wood Gundy, and now CIBC Private Wealth, and that's how he's been with CIBC and affiliated there for the last 22 years, and I've been on the team for the last 11 years. I'll let you start.
So, Ankit mentioned something very important. When I started the practice in 2000, at that time in Canada, options were not known at all. Absolutely, there was only one person by the name Richard Croft. He will be sometimes on TV talking about options, you know, Barrick Gold and some of the stocks, mostly Barrick Gold, right? But options were not understood in Canada at all. I had exposure to options in London, England, 1982. When it was still fairly new at that time. In London also, it was only I think 4 to 5 years old. But then there was a outfit by the name London Traded Option Market, and they used to advertise in the press, in Financial Times, we want to educate people, we want to get more involvement of the people, because options are very good tools to protect the portfolio, to manage your portfolio. So I enrolled in that with another friend of mine, and we learned options, in a wrong way. Wrong way, you know, what is the wrong way? Wrong way was buy options, and you know, essentially when the stock is down, you buy options instead of buying the stock. Stock is $20 or 20 pounds. Option is only 1 pound. Stock goes up by 2-3 pounds. Option goes up by a pound. So you have doubled your money. Right? But that was the wrong way, because most of the option buyers, when you buy something, when you buy a book, when you buy a pen, anything, you are paying money, right? So in the case of options, the biggest issue was you can get the direction of the stock right, but not the timing always, right? If you are Nvidia stock or any stock for that matter, if you have bought it and it does not move up during the time frame, if you have bought 3 months time, it does not move up, you have lost your money. So almost the statistics says 85 to 90% of people lose money when they buy options. So we made a lot of money by buying options, lost all, a bit more, right? And then the light bulb, immediately I thought, hey, you have to be on the other side. You have to sell options. Whether it is selling call or selling put, you have to sell options. You cannot buy options. When you sell something, you get cash. But what we are doing in the case of option is only we are selling time. Now, before I proceed, the most important thing is I wanted to thank the whole team, because lest I forget, I want to thank my family. The whole family is involved. They are doctors, and you know, but they are all involved. I want to thank Montreal Exchange, which involved me, which found me in 2005. And they said, Avin, we want to come and talk to you. I said, well, I don't do third-party products. I do my own stuff. They said, no, we are not talking about third-party products. We are Montreal Exchange, country's derivative exchange. You are sending the maximum volumes to us. That's why we want to come and talk to you. Because our main objective is that, you know, we should educate public so that people understand that options are excellent tools to protect the portfolio, to generate additional income. So I started working with them. So for the last 18 years, they have been one of the big supporters. We work together in educating the general public. And that is how, one of our workshops, tomorrow's workshop, is sponsored by them. So they are paying for everything. But you know, I want to thank them for being with me, for being with our team for a long time. And I also wanted to thank the Option Industry Council in US, because they are also huge supporters. And they also have some presenters here. So they fly out from New York to present to the public here, present to the investors. So before anything, I thought I'll thank them. And more important, I want to thank all of you because on a Friday, taking the time off and coming here, kudos to you. Thank you. Right? Now, after this background, probably I'll talk about the agenda, today's agenda. That is, this is what we are going to cover. Now, my only request is normally our presentations are for 1 hour 15 minutes, but today we are given 45 minutes. Today and tomorrow, both days, we have 45. Tomorrow also we have 45 minutes. So I am trying to compress everything, condense everything into 45 minutes, right? But then we have a booth. When I spoke for the first time when I presented in 2019, at that time we did not have a booth. I presented, went outside, people said, well, where do you find us? Or where do we find you? And I had no answer at all because I presented and I went off. 2022 we decided to get a booth so that people can come after presentation and any questions they have, because I understand options for almost, we are talking 1982, something like 41 years, right? So I'll have an answer for any of your questions on options, right? So kindly come to the booth 311. So we are talking about, when I started presenting first, I thought, what is the best way to present a complex subject, complex concept? And the thing is, people don't understand, they can't put the mind around options. So I thought, let me start with real estate. So the first presentation I designed for Merrill Lynch, I said, well, rental income on stocks. And they said, what is rental income? I said, rental income is basically option premium. I said, well, okay, very grudgingly they approved that. They said, okay, this is Avin Mehra's view. That was in 2000. Now in 2023, you'll find many books which talk about rental income on stocks, right? It is, so my thinking was validated. But why I used rental income? Because people understand real estate much better. That's why. It is just to simplify the concept, nothing else. So concept from real estate investing, then we'll define what are call options, what is involved in that, why we do call options, how we do call options, and then we'll talk about awareness or liquidity issues. Then uses in year-end tax balancing. This is very, very important because unfortunately in Canada people don't understand this. Options are excellent tools, not only for portfolio management, not only for generating additional income in the portfolio, they are excellent tools for tax management also. So we'll talk about that, and we'll talk about some of the alternate option strategies. We'll try to compress everything in 45 minutes, and then any other question you have, we have a booth and we have a business card. Any question on options, we'll be able to answer. Concept from real estate investing, Ankit, I give it to you in 5 minutes. Okay, no, less than 5 minutes. Okay, concept from real estate investing. Real estate in downtown Toronto Financial District, we will give you 2 examples. The first one is real estate, it can be anywhere at all. Now, how many people here own real estate? Terrific. That is almost half of the people. Now, the question is how many people own investment real estate? So, probably 10% or 15%. Right, and I can understand that because right now investment property is a big challenge at this stage because of the interest rates being very high, right? So main thing is the difference between the two is this: when you own a property where you have to live, when you own a property which is your principal residence, you do not mind whether your property is worth 1 million today, tomorrow it is 800,000. You have to have a place to live. So that does not count at all. It is only the investment property. When you buy the investment property for $1 million, now $1 million is very common in Toronto now. It's not a big deal. But you buy for 1 million and interest rates start going up. Your property, you are looking at what is happening around. Property goes down to 900,000. So many people they are selling the property. There are so many people who have booked the property. They have paid, made the down payment 200,000, and they are walking away because they cannot get the mortgage, right? So real estate, the investment real estate, that challenge is there. You know, it works very well with the interest rate. When the interest rates are low, people can borrow to the head, right? Especially when the real estate is expensive in Toronto, for example, or Vancouver, right? But when the interest rates start creeping up, it is very, very difficult to manage, right? So that is the concept of real estate. So the first example I'll give you is this. It can be anywhere. It can be in downtown Toronto, it can be in Vancouver, it can be in Brampton, wherever. But you know, to keep it simple, let's say you buy the property in Toronto or GTA for $1 million, right? Now, what happens is, you know, your realtor, real estate person is pestering you. He says, buy this real estate, this property. Why? You buy this because this property was selling for 1.2 million. And now because, you know, things are bad, people cannot manage, they cannot pay. So this is distress sale. So you can buy it for $1 million. And you are saying, who has a guarantee? You know, I buy for 1 million, it can go down to 900,000. It can go to 850, who knows, right? Because interest rate can still go on creeping up. By the way, you know, today I attended presentation from Benjamin Tal this morning, and he was saying, you know, it is overkill by Bank of Canada. They have to stop somewhere. You know, they are increasing the interest rate, they are creating so much harm in the economy, right? It is his view, not mine. Because if it is my view, CIBC might say, no, 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 you cannot say that. But he can say that, definitely, and I agree with him. So main thing is, the property is distress sale, real estate agent says you come and buy it. Why? Because after 1 or 2 years, when the real estate, when the interest rate come down, this property will go back to 1.2 million, right? And you are sitting on the sidelines. Then this guy says, you know, do one thing. You say, why don't you buy it? Say, I don't have money. I have 5 properties. I am totally, you know, right up to this, bank won't give me any more loan. So you buy it. Do one thing. I am so confident about this property. You buy the property for 1 million, right? Sign a contract with me so that I can buy the property from you in 1 year's time at 1.1 million, right? Because he is so confident it will go back to 1.2, right? If you do that, essentially what you have done is you have hedged, you have reduced your cost. You know, you paid $1 million, you took out $100,000 just to have the right of first refusal from this real estate agent, right? Because you cannot sell it to anybody else, you can sell only to him. If the property goes back to 1.2, 1.3, you are stuck. You cannot sell it to anybody else for that 1 year period only, right? So what you have done is, you have hedged. So basically buy the property for 1 million, sell someone the right to buy it from you at 1.1 million in 1 year, and they pay you 100,000 for getting this right of first refusal. Now their risk is, if the property does not go up in value, they lose this $100,000. So they are buying time, 1 year. You are selling that time. So when I said sell time and collect money, this is the situation. So you are partly hedging your situation. So they pay you 100,000. So what happens? Only 3 possibilities. When you buy the property, it can either go up in value, or does nothing, or can come down in value. No other possibility, right? So the first one, if the property goes up in value, as this person mentioned, the counterparty mentioned, goes up to 1.1, 1.2, anything at all, right? You make money, but you are stuck. You cannot get anything more than 1.1 million. Property goes up to 1.2, you cannot get 1.2 million, right? You are stuck at 1.1. But then, how does it matter? Question is, you have hedged. You bought something for 1 million, you took out 100,000, your cost is 900,000. If it is sold at 1.1 million, you are making 200,000 on 900,000 net cost. So you are making 22%. And these numbers, it is just for the ease of understanding. It is not necessarily 22%, it can be 10%, 12%, anything at all. But main thing is you have partly hedged your position, right? So second situation, when the property does nothing, that means goes up down sideways, after 1 year, because contract is only for 1 year, the property is below 1.1 million. And that was the agreement. If it is more than, he'll take it from you if it is at 1.1 million. But if it is 1 million or 1,050,000, he won't take it from you, right? So in that case, you keep that money. Your cost is permanently reduced to 900,000. You can pay again. You can have the next contract. The third one is the most important one. Third one is the property actually goes down in value. But then what happens is, if the property goes down to say 900,000, you bought for 1 million. Now there is no possibility that this guy, and you are getting close to 1 year time, there is no possibility that this property will go up to 1.1 million. So you go to the counterparty, this real estate agent, and you say, okay, do one thing, free me up from this contract, right? I'll give you $10,000 from 20,000 to free me up, because if you wait till the end, you may get zero, because property is so much down, right? So what you do is, when you see there is an opportunity in the market to buy back that option, that contract, and you sold something for 100,000, you buy it back for 20,000. So you start making money in the rights market or option market, right? So whether property goes up, down, sideways, up, the only problem is you are capped. If it goes sideways, you keep all the money. If it goes down, you start making money in the rights market. So in all the situations, you are laughing. The second example that I wanted to give was, buy the property for, here there is no counterparty, nothing. The real estate agent comes and says, you buy this property, I have already found tenants for you, they are good for the money, right? So this tenant is giving you $4,000 a month, or 4, 5, whatever it is, right? So the moment you start generating cash flow from the property, your sleep at night factor improves, your risk improves, because you know that you have the cash flow coming in till you are sitting on the property, right? And that means you have a choice. You can sell it tomorrow, you can sell it after a month, 2 months, 6 months, whenever, right? You have a choice. So that is a sleep at night factor. You are not in a hurry to sell. Now I'll define what is a call option. This is right to buy a specific property. So in this case, the real estate agent, he had a right to buy this property from you. So he had a right to call for the property. That's why they call it call option. He had an option to call for the property, right? And you are the seller of that option. So you are collecting money by selling that right. Okay. So now we can use this concept of real estate. We can move it straight away from real estate into stocks, into ETFs, into indices, anything at all. This real estate example that I gave you, there are actually deals done in US, right? And I hope someday, I mentioned in my last year also, that hopefully someday we'll have the fractional thing. You have 1 million divided into say 100 parts or so, so fractional thing, so that you can do option on real estate as well, right? But now I'll request Ankit to go ahead with this.
Thank you so much. So the premise of this presentation, we started off by talking about real estate simply because everyone tends to have an understanding of it before we talk about call options, because unfortunately in Canada, a lot of investors, they find options to be risky, but that's not necessarily true. Options are a two-sided tool, as he mentioned. You can use it to speculate and gamble, or you can use it to protect your portfolio and generate additional income. And we're on the other side. You can kind of think of it as a casino. If you go to a blackjack table, why does the casino always win? Because they can keep playing out on hands, but then they're occasionally paying out. They're winning more money as it's coming in. That's why casinos tend to be profitable. So when we're selling covered calls, or the next strategy, which is selling cash covered puts, we're collecting income, and out of 10 times, 8 times we tend to collect that income, and the other side tends to lose statistically. So we're on the other side.
And essentially, I'll just add one point, that is, when you sell something, you collect cash. So here what we are doing is, we are just selling time, that's all. When you sell your expertise, you do a job, you get money, right? Here we are just selling time and collecting money. When they say time is money, this is a real example of that.
So we can transpose this now to the stock market. Instead of talking about individual stocks, we're going to talk about one of the ETFs which we did a trade for. This is our real trade. We're eyeing XLK. This is the technology ETF. The top holdings are Apple, Microsoft, NVIDIA, Rather than betting on any individual stock, we get into the ETF because individual stocks we know can pose their own risks. For example, yesterday we had the announcement out of China where they said the government will ban the iPhone potentially for the employees. So rather than being stuck in Apple, which went down 6.5% over the course of those 2 days, we knew Microsoft did not go down very much, Nvidia did not go down as much. So that's why we buy something like an ETF, and we overlay that ETF with an option without taking the individual stock risk. So technology sector ETFs, Spider Technology.
Understands what is ETF? Exchange Traded Fund, right? Trades stock on the exchange.
It's a basket for the sector. Right. The 52-week trading range for this ETF, 112.97 and 181.46. So a very wide trading range in the last year, primarily driven by the fact that technology has been very volatile. Even Apple stock individually, it was as low as 126 and as high as 198 in the last 52 weeks. And it is a large component of this basket ETF. So we buy the ETF and we straight away give someone else the option. We reduce our cost. We give someone else the right to take that ETF away from us at a certain level within a certain period. We're selling time and we're collecting income for a certain period of time. And why we're specifically doing it is, again, we want that peace of mind. Just like the real estate example, we bought this investment property. We don't want to be in a situation that Apple stock, it continues to go down, or the ETF continues to go down because Apple is an underlying component. So we continuously chip on the cost by selling covered calls, selling rights, like we did in the real estate example. So not only are we generating the income, but we're also protecting the portfolio partly to the downside. Not fully, but partially. So on August 9th at 10:24, we buy everything in blocks. So blocks of thousands, 5,000, 10,000, 20,000 shares, not for one individual client. But we buy everything in block just because we're able to get the best pricing on both the stock side as well as the option side in terms of execution. So all clients are able to benefit from that. So XLK, we bought at 169 per share on August 9th, 10:24. Rather than hoping that it would go up, or we don't know what happens in the markets, we immediately, after buying the stock, sold a call option. We've given someone else the right to take XLK shares, technology ETF shares, from us at 170. We've capped our upside from 169 to 170, only $1 upside. But for that right, they gave us $9.35 in income today. So our net cost is the $169 that we paid per ETF, minus $9.35 per share, which brings us down to $159.65. So same real estate example, we don't know what the markets do. But as far as the mechanics are concerned, the stock can go up, it can go down, or it can trade sideways. If the stock goes up, we're capped at 170, but someone will take it away at 170 and we'll have cash again in the portfolio to reinvest into a different deal. If it goes down, which is the more worrisome scenario because we got this news out of Apple and that did cause some pressure on the unit, we can go back into the market, let's say in November or closer to that December expiration, and buy back that same option that we sold at $9.35 for, let's say, $1, because time has passed and we've sold time, so there's not as much time left. We profit $8.35 on the option, and then we sell a new option in the context of where this unit is trading. If we find that it's trading around 165 or it's at 160, we'll sell more time till March or June or next year. We'll leave even till 2025 or 2020, late 2024. So it's very active. You have to constantly monitor not just what the unit is doing, but also what the option market is doing as well.
But the whole objective is continuously go on chipping on the price, original price, for indefinite period until you hold the security.
But for this specific trade with XLK, the best case scenario for us in 4 months is we lock in a gain of $10.35 per share. So we bought at 169, we took out $9.35. Our cost is $159.65. So if it is taken away at 170, we're making that $10.35 on an investment of $159.65 in 4 months, which is not 6.48%. And we don't annualize or anything just because we don't know where XLK will trade later. And the option premium is determined based on various factors. And one of the factors which is key is volatility. But we do know that we have downside protection in that time of 5.53%, which is great for an ETF, and it's that peace of mind factor that we have built. Tax piece. So options are taxed as capital gains. So they're not taxed as income, they're not taxed the way dividends are. They're the most efficient form of taxation, the income that we're generating from options. And all of our transactions exclude transaction costs. In our case, clients pay a fixed fee and there's unlimited trading. And we do need that because sometimes we're doing 400 or 500 trades in a household per year. And that turnover is because of the options. We're constantly trading the options to be able to reduce our cost. Sorry, if I can borrow that second one, yes. So in this booklet, there's one colored sheet. It's the fourth last one, this colored sheet. It actually shows you examples of some of the sample trades that we have done. For example, at the top, in March 2022, we had bought Apple at $158.50 per share, and through the options, we have reduced the cost to $132.85. So our objective is we own the stock and we keep on trading these options to continuously chip on our cost. And a lot of people argue, they say that, what if the stock goes to zero, or what if it goes to $50? First of all, we only invest in areas which we don't believe will do that. We only get into blue chip stocks or into top areas, top companies which you would be familiar with. But say it happens to companies like Disney. We're seeing Disney, it's gone from $202 per share 2 years ago to yesterday it dipped below $80 per share, which is more than a 10-year low. If we find that fundamentals have deteriorated a lot and we've reduced our costs substantially, but we find that things are still going down, we do bite the bullet and reinvest the cash into some other deals. But we do that during tax period, tax time. But this shows all of the trades that we did for these stocks on both the stock side as well as the option side, and how we've been able to constantly generate this income, cash flow, and generate returns for our clients. So in very bad markets like last year, we had the S&P 500, which was down almost 20%, the Dow Jones, which was down almost 9%. We were also down, we were down about 5.5%. Whereas in this market this year, when the Dow Jones is up about 4%, the TSX is about 3%, the S&P is up about 16%. In that market, we're up about 10%. So we don't get the full upside, but we also are able to cap the downside risk in the portfolios. And most of our clients, they do like that because they don't like seeing downside volatility in their portfolio. They want to be able to generate consistent income on their portfolios and retire in peace instead of having to worry about what happens in markets sometimes.
So what else do cover costs do very effectively? Help in managing taxes. The year-end tax balancing, what we do is, when you look at the press at the end of the year, around November, you will find many articles saying that, okay, you want to create gains for tax purposes, you have previous losses carry over, so do the switching, sell Royal Bank, buy TD, or change the ETF, sell this ETF, buy this ETF, that type of thing, so that you can create gains or losses to balance the taxes, right? The most important thing, most important vehicle for managing that is options, because options, you have so many possibilities. You can move the series from November to December, November to April, November back to October, you can do anything. So what we do is, in the month of November, around 15th November, we send a note to every single client, kindly look at your tax return, and last year tax return, and column 127, now it is 12700 taxable capital gain, and 25300 losses, capital losses carried over from net capital losses from the other years. Give us that information, not only for last year, for the previous 2 years as well, because CRA allows you, in case you have paid any taxes 3 years ago, capital gain taxes, and you create losses this year, you can recover the money from the government on taxes already paid. You can go back only 3 years, right? So we do that balancing for everyone. We first of all balance this year, and then we will go back and try to see if we can recover the money from CRA on taxes already paid. And this we do primarily by using options, right? So because options, as I said, lot of flexibility. It is not stocks only or ETF. It is we go to stock or ETF after we have exhausted options. So that is help in managing taxes. Secondly, partly protecting the embedded gains. There are people who bought Royal Bank or CIBC or any of the bank stocks some 30 years ago. So stock did well. Right now they are not doing very well, but overall they have done well, and they have split so many times. So what they find is they bought the stock for say $60, and then after split, it is worth about $10. Their purchase price. In the market, Royal Bank is at 120 or so, right? So if they sell Royal Bank, there is a huge tax liability on capital gains, right? They don't want to sell. They don't know what to do, because if they don't sell and Royal Bank comes back, Royal Bank was 140 just few months ago. Now it is 120 something, right? So then they are worried that your stock will go down. But if you are using this strategy where you are just selling time against the stock, you never need to sell the stock. Keep it for indefinite period. Go on collecting rent on stock. And that is in addition to dividend. Both the incomes are tax preferred. The option premium, right, that is capital gains. So you pay tax only on 50% of that. Plus you have stocks or even ETFs or even the indices which are also giving you dividends. So dividend is also tax preferred income. Both are tax preferred income, right? Then help in managing the two human emotions of fear and greed much better. This I already covered. You know, the greed is, oh my goodness, my stock is called away, or my real estate is called away at 1.1 million, because now it is 1.2. I should have waited, right? That is the greed. Fear is when it goes down, at that time you are worried. So basically, if you are using this strategy, both the human emotions, which unless you are a Warren Buffett, we all have those human emotions, right? If you talk to Warren Buffett, he says, oh, I don't buy stock. I buy businesses and I stay in them for indefinite period. And then, you know, we read Warren Buffett all the time, and we'll say, okay, now this guy, he is saying, okay, this particular stock, he is putting a put at $60. Occidental, anyone knows? Occidental Petroleum. So he is buying, whenever it is below 60, he'll buy more, right? And we say it is his Warren Buffett put. So whenever it is below 60, we also buy. It is a lot of fun. So go to the next one, please. Why everyone is not doing despite resounding endorsement by Wall Street Journal? First is lack of knowledge, and which we are trying to change. We are working very closely with Montreal Exchange and trying to educate general public. And we don't mind traveling anywhere at all. We don't mind, like, you know, if you have a group of people, 10, 15, 20 people, and you say, okay, you know, come and do a presentation in Brampton or do it in Mississauga or wherever, we can do it for you. We are educators. I started the practice only because I had confidence I could teach anything. I taught law, I taught mathematics, I taught economics, right? So I had that confidence that I can basically convert the complex concept in plain English so that it is easily understood by people, right? So if there is any financial issue, we have in our on our website, we have all the seminars that we conduct, different topics. In addition to that, if there is any other topic you are interested in, any financial issue, we can design a seminar, get the compliance approval and deliver it wherever you want, right? So lack of knowledge is one. Second is, so we are trying to change that. Second is market perception that options are risky. They are risky if you are a speculator, not when you are a hedger. So they are risky when you are buying options. When you are selling options, you are selling time and collecting money. That's all you have to know. Then difficult to execute unless you are in the market. You are always treated against professionals in a very thin or illiquid market. So what we do is we do most of the trading in block, right? So we are able to get finer pricing on the stock as also on option. The other thing is, you know, if the stock is called away, oh my goodness, my Apple stock is called away at 180. Or last year, you know, we presented 2 workshops. One was on Dow Jones, DIA. Second one was on Apple. Fortunately, both did very well. It is just sheer luck. That's all. We do not know XLK whether it will go up, down, sideways. We don't know. But after our presentation today, we will talk about XLK in the real market, what is happening there. We will talk about other stock, any other stock you are interested in. But main thing is, it is difficult to execute unless you know what you are doing. If there is a mistake, it can be very costly. then very few professional investors, investor advisors grasp it or are ready to spend the time and effort in watching the market closely. And this is again something which we are trying to rectify. We are working with the Montreal Exchange. We are trying to, in 2013, I am with Montreal Exchange from 2005. 2013, they asked me to address the portfolio managers and investment advisors, 70 of them. I said, okay, this is what we do, right? If anyone of you is interested, come and sit in my office, understand the process very well. How we do it, how we use Pareto principle, top 25 securities cover 75% of our book, that type of thing. You can learn that so well and you can try implementing in your own book. Not a single person, no one came. So my request to you is, as investors, kindly ask your people, ask your investment advisor to understand these things, because these are very, very important. These are hedging techniques are so good. So, and if they need any help at all, we are there to help them, right? Because that is our objective, working with the Montreal Exchange. And then last thing, strategy may sometimes curtail upside. We talked about real estate, we talked about Apple. Sometimes you don't get the full upside, right? So
I'll probably segue into the put option strategies. So as far as put options are concerned, they're the other side to call options. So for us, we only sell options, whether it's a call or a put. When you're selling a put, it's like selling insurance. You can think of Sun Life or Manulife. They've sold a insurance policy. It can be a whole life insurance policy based on life. It can be for disability, or it can be an auto policy with one of the auto insurers. But essentially, when you're selling insurance, if that event actually triggers, that's the only time where the payout happens. The difference between what we do is like the Occidental Petroleum. Warren Buffett said that he's prepared to buy Occidental at $60, and he's almost put a floor on the stock. So if anyone wants to buy it at 59 or 58, he says, I'm agreeing to buy it at $60 per share. So he's put almost an artificial floor. And if the stock does well, it should be fine. But when you're selling insurance, it's only triggered when a certain level is reached. And we'll talk about XLK in particular, because we're discussing XLK on the covered call side. Say that we have cash in the portfolio, but we feel that this stock has gone up too much, or this ETF has gone too much in value, and we're not comfortable with paying that price. We can keep that cash as collateral in our portfolio and sell a put option, sell insurance that we're prepared to buy this unit from you in the next few months at a cheaper price, and in return you're paying us a premium. So if that stock reaches that level, or if that ETF reaches that level, only at that time we'll be given XLK shares. Otherwise, if it doesn't hit that level, then we've collected that insurance premium when we sold the put option. So with XLK in particular, let's say it's trading at $169, but we only want to pay below $160 per share. In that situation, we can sell a put option till December at $165, where we're giving someone else to give us XLK by December at $165 per share. If it actually reaches $165, only then we're obligated to buy it. And for that, we're collecting $6 today. Our cost drops from $165 to $159. Because we collected that premium up front. If it stays above $165 per share, we're collecting that premium on the idle cash which we have in our portfolio. And that idle cash can be invested in a GIC short-term, any money market security. So it's not just generating this income, but also the GIC or short-term money market return that you can generate for that period. So this strategy we use very effectively, where we had a holding of Apple and we sold off some of these shares at a good profit. We thought that the stock is starting to sell off, so let's take profits where we did covered calls, keep the cash, and sell puts to buy the same stock 10 to 15% cheaper, because there were some issues with China and we didn't want to take that exposure in certain client portfolios. So we made that decision where we sold Apple and immediately we set it up to be bought a lot cheaper in case the stock were to fall down to a lower level. And that's where the active management comes in. We need to constantly...
That also means your existing holding, if you have Procter & Gamble, if you have Johnson & Johnson, if you have Apple, Microsoft, anything at all, or NVIDIA, sell them off at high point and then sell the put option to buy them cheaper. Even the existing portfolio. You can do it with all the stocks, all the ETFs, all the indices.
So essentially you have cash and you don't know where to start, or maybe the markets have gone up so much and you find you want to crystallize the gains in case the markets crater. And September and October traditionally have been months where the markets have not been strong from a seasonality perspective. So when selling puts, you're essentially keeping cash aside to buy stocks or ETFs, which you would want to buy anyways in your portfolio, but you're not as comfortable with paying the price that they're trading at in the market.
Yeah. So key takeaways. One is security selection and diversification are vital. The default theory is simply in 2000, I don't know how many people know Northern Telecom here. Some of my older friends like me, they would probably remember Northern Telecom. The thing is, at that time when there was .com crash, there was an article in Wall Street Journal saying that if your stock has gone from 100 to 10, which is very much possible, which happened during that time, so it is 90% down, next year it goes up by 100%, 10 to 20, you are still in deep hole, you can never recover, you cannot go back to 100, right? That is deep hole theory. Always avoid deep holes. That means, stay with something which you understand very well. That is also Peter Lynch philosophy, invest in something that you understand, right? So security selection, diversification are key. Now having said that, we find many cases like, we have good holding of Walt Disney, right? And we are not selling it, but it is a pain for time being, right? Because, stock goes up to 205 from 95 and then comes back to 80, below 80, right? It is crazy. But if you are diversified, if you have Disney, if you have Procter & Gamble, if you have Johnson & Johnson, if you have Microsoft, if you have ETFs, XLK, any of them, and mostly the best one is if you look at S&P 500, the top 500 US companies which are very diversified, international companies mostly, invest in them, those are divided in 11 different sectors, right? So depending upon, you can look at which sector you are comfortable with. For example, XLP is consumer staples, right? You are comfortable, you have Procter & Gamble there, but tomorrow something goes wrong, Procter & Gamble, US dollar appreciates and suddenly their income when translated into US dollar goes down in foreign currency translation. But then they are down, Costco is up within their sector, right? So you have that hedging automatically. So but security selection is very important, diversification is very important, right? In addition to sector ETFs, we extensively trade options on indices, Dow Jones, S&P, QQQ, and in top blue chip stocks which carry decent option premium and robust option market. The problem in Canada, even though we are working very closely with the Montreal Exchange, but somehow the market has not developed to the level which we would like. And that's why I wanted to request all of you to get involved in that. So that, at this stage, probably 95% of our book is in US. When I started, 95% used to be in Canada. We want to come back in Canada. So we need help from everyone there. In Canadian market, due to less liquidity, high bid-ask spread, our trading is mostly in weekly options that offer better risk-reward opportunity. Montreal Exchange, which is part of TMX group, they are the country's derivative exchange, stock, options and futures. They are actively educating portfolio managers, investors on option strategy to drive option volume in the marketplace. And time is money, we already talked about. Time is money. When you sell time, you are collecting money. This is a real case of collecting money by selling calls, selling puts, right?
Great. And we'll probably just stop the presentation there because I know we've reached the 2:30 marker. But if you guys do have any further questions, you can come to our booth and we're more than happy to go through the actual examples.
Oh, sorry. Just give me 1 minute, please. We have some reference books there. The first one, Cover Call for Beginners, is really very, very easy, plain English. And we have book draw for them as well, right? So we have some of the books listed there, right?
Right, so we've given out a feedback form. If you guys can fill out the feedback form when you have a chance and drop it to the booth, there's a chance to win some of the books that are on the table we'll be doing a raffle later for books. All right, but thank you so much.
Thank you very much.
Thank you.
Thanks everyone. Take care.
Thank you.